Let me ask you something. In the last 5 years, how many times have you heard somebody say, I've never seen anything like this before? Things feel really different. Maybe you feel inside things are really different. Whether it's about inflation hitting 40-year highs, supply chain disruption, geopolitical problems that seem worse than ever, or market volatility that just seems to have gone berserk. Here is the thing. We have been here before. There's nothing new about where we are right now. Not exactly the same, but if you study history long enough, you'll see that things rhyme. It never repeats exactly, but it always rhymes. So really it's societal factors, it's personalities and psychology of individuals, the individuals and how they feed into the masses. That's what creates history and cycles that rhyme. Most financial advisors are still using investment strategies designed for the stable growth period since the 1980 to early 2000s. That's why so many portfolios got crushed in 2022 when stocks and bonds fell together. Modern portfolio theory failed. Everything fell together. We've seen a bounce since that time, but that was the first wake-up call for a lot of portfolio managers and a lot of individual investors. In fact, during that time, bonds fell more than stocks on average. So the balanced portfolios didn't work. We're currently living through what historians call a fourth turning. And today I'm going to be talking a lot about the societal structure called the fourth turning theory. Each of these turnings is about 20 years. We're currently in a fourth turning. And what that means to you, what that means, even though we don't know exactly what's going to happen in the future, there's some similarities that we can draw from that can help us figure out where we are today. If you don't adapt your financial strategy to this new reality, you could lose decades of wealth building process as a result. Just when you need the money most for retirement. A lot of people watching this are either close to retirement or in retirement. And we've been lulled to sleep. A lot of us have been lulled to sleep. It's natural. That's what the Fed has been wanting to do. And other central banks, they want to pump asset prices up so that we're all not worried. Well, there's reasons to be worried because of the cycle that we're in right now. I'm Mike Preston at New Harbor Financial. And today I want to share with you a framework that's helped me understand not just what's happening in the economy and in the markets right now, but why it's happening. And more importantly, what it means to you. It can help us predict what's going to happen next, even though we'll never know exactly when or what's going to happen. We might know why it's going to happen, though, because that's the cycle that we're in. I've been helping clients navigate volatile markets for over 2 decades. We've been doing that here at New Harbor since we've been founded over 2 decades ago, including through the 2008 financial crisis and the recent inflation surge that happened after the COVID event. The $7 trillion in stimulus from our government caused runaway inflation. The fourth turning theory, developed by William Strauss and Neil Howe, accurately predicted the 2008 crisis, and that would start or would mark the beginning of this next current period, this fourth turning. Their track record gives us, and their book and theory gives us an idea what's going to happen next. I'm not here to predict the future. Nobody can do that. But I am here to help you understand certain cycles and patterns that can help you make some decisions that can hopefully help you out and help you avoid some pain. So all of this is happening during a time that we've never seen a more overvalued stock market. So here's a long-term chart going back 100 years that essentially shows the S&P 500 index in blue and shows what level, based on John Hussman's model, we'd need to be at to achieve 10% returns over the next 12 years or so. So take a look at this chart. You can see that the green line here basically predicts we need to be at around 1700 on the S&P 500 to achieve 10% returns. This model is very, very good. Now here's the thing, it hasn't mattered. This market has been brutal. It's been different for longer than ever before. But the data behind John Hussman's work, I think, is good. I think his model is good. He bases it on non-financial market cap divided by non-financial gross value added. Here you can see that we've had long periods of diversion or movement away from this line. And each time we've tried to correct, it has snapped right back. And so we've been overvalued relative to a 10% expectation, really for most of the time since the mid-90s. That is a long time. This chart is a dot plot, which essentially shows that measure of valuation that we just talked about. Non-financial market capitalization divided by corporate gross value added. And over here on the y-axis, actual subsequent 12-year nominal returns. And so this goes back over 100 years, back to 1928. And so essentially, we're looking at the starting period in terms of valuation, and then plotting what the actual 12-year return was. And take a look at this. From 1928 to 1998, you see a pattern distribution here, and it tells you what to expect in terms of forward 12-year returns. But things have been so overvalued permanently or relatively permanently since 1998 that that data set is permanently skewed to the right. Those are the dots in green. So that's probably not permanent. It feels permanent, certainly, and this 20 plus years spans, or even 25 or 30 years spans the good portion of most people's career. But this is not normal. This is what you might expect in a fourth turning. This is a time of maximum effort, maximum conflict, and maximum risk. But putting all of that aside, take a look at where we were as recently as June 10th, 2025. Here's the most recent dot. This predicts, if this model has any value at all, minus 6% annual returns over the next 12 years on the S&P. We don't know if that will happen. We don't know what the path would look like if it happens. It could crash and then claw back to even, or it could just drip slightly down. Who knows? I think we're likely to see a crash because that's what the fourth turning does. It's time of maximum risk, maximum change. These are transformative moments. But remember, as we go through this talk, that we're living at a time where it is more overvalued and more risky than ever before to have a passive strategy blind in the stock market. I'm going to define the fourth turning for you and tell you a little bit about what each of the turnings are and give you some historical context of what those times were for us in the United States. Next week, I'm going to give you some specific strategies to help you protect and grow your wealth during these challenging times. So don't forget to tune in next week as well. So what exactly is a fourth turning? Strauss and Howe discovered something remarkable when they studied American history. It moves in predictable cycles. Each complete cycle, or they call it a saeculum, an ancient word for a complete cycle. Each one lasts 80 to 100 years. Roughly the length of a long human lifetime. Think about it. That means every few generations, society essentially starts over with a clean slate. And they actually theorize that it might have to be that way because oftentimes during fourth turnings, there's so many bad things, unfortunately, that happen, so many horrors that happen that anyone that lives through it on the other side is determined to never let it happen again. Of course, when those generations are gone, the cycle can repeat. So each complete cycle or saeculum, like I said, has 4 distinct phases or turnings. Each of these 4 turnings is about 1 generation in length or about 20 years. The first turning, also called the high, really this is probably the best time to be alive. This is the rebuilding phase. Think about right after post-World War II. Strong institutions, shared values, everyone's in this together, strong economic growth, and optimism about the future. In this case, the individual is less important than the institutions and society as a whole. Patriotism, everyone's pulling in the same direction. The economic growth is off the charts. This is just a fantastic time. The 1950s and early 1960s were a classic first turning or a classic high. If you look back at history, you'll see that this is the first time that we had 2-income households. Women went to work a lot of times during the World War II and they stayed there. After World War II, that created a lot of gross domestic product. A lot of home ownership went through the roof. For the first time, we had homes that had 2 cars. So just a wonderful, wonderful utopian time, first turnings. The second turning, the awakening. During this time, society begins questioning institutions and values. Think of the cultural revolution of the 60s and 70s. Civil rights, women's liberation, environmental movement. People want personal fulfillment versus institutional conformity. So this second turning or the awakening was early 60s to mid-late 70s. Remember, all of these dates are approximate. Nothing is perfect. This is a construct, but I do think it's helpful to understand these. The third turning, also called the unraveling. During the third turning, which in this country was early mid-1980s through to mid-2000s up through about 2008. During the unraveling or third turning, institutions weaken, individualism peak. Think about Wall Street, greed is good, the famous quote. Wall Street. And society becomes more fragmented. It's all about me during the third turning and not about us. And then that brings us to the fourth turning, the crisis. That's where we are right now. It's a period of intense upheaval lasting 20 to 25 years. Old institutions either adapt or die, and new ones are born from the chaos. The fourth turning probably started in 2008. That's what Neil Howe thinks. If it lasts 20-ish years, it should go through about 2030 2030. Here we are in 2025. So if you believe in this construct and this theory, that means we're in the final 5 years. And put that against the backdrop of the most overvalued stock market in history, with maximum effort everywhere to keep the status quo, you can just imagine what this is going to look like if this starts to fall apart, which history says it will. Let me give you a concrete example. The last fourth turning ran from 1929 to 1945. It started with the Great Depression, the complete and utter breakdown of the economic system. But it did not end there. We had a massive government expansion with the New Deal, World War II, and finally the emergence of America as a global superpower with entirely new international institutions. That's when we started the first turning. Again, the best time of all. The generation that lived through this, what we now call the greatest generation, emerged with a completely different worldview than their parents. They built the modern middle class, created the suburbs, established the economic boom that lasts for decades, a long, long time. Now, here's what's critical to your financial future. Strauss and Howe wrote in their book in 1997, and they predicted that the next fourth turning would begin right around 2005 to 2008. Sound familiar? They were remarkably accurate in hindsight. The global financial crisis, the GFC of 2008, marked the beginning of the current fourth turning and should last till about 2030. Again, about 5 more years. Now, you might be thinking, Mike, this is interesting history, but what does it mean for me? What does it mean for my portfolio? Let's talk about that. Let me connect the dots for you, because when you understand the fourth turning framework, today's headlines start making a lot more sense. Let's first talk about geopolitical tensions. Fourth turnings are characterized by major power struggles, both domestically and internationally. We're seeing this play out in real time. The strategic competition between US and China isn't just about trade, it's about who will shape the global economic order over the next several decades. A long, long time. The war in Ukraine, the tensions in the Middle East, and the fracturing of global supply chains, these aren't isolated events. They're all part of the same pattern that we've seen in previous fourth turnings. Again, history rhymes. Domestically, we're experiencing the kind of deep social and political divisions that are hallmarks of crisis periods. Think about red versus blue, blue versus red. Trusted institutions, whether it's government, media, or even corporations, is at historic lows. This isn't just about politics, it's about the fundamental restructuring of how society organizes itself. And economically, we're seeing exactly what you'd expect in a fourth turning. Inflation that seemed impossible just a few years ago. It peaked out at 9% a couple years ago. That wasn't seen in decades. National debt levels that would have been unthinkable in previous generations. We're at 37 or 38 trillion the last I looked. And we're going up by 3 trillion a year. It's not sustainable. There is no plan B. We're all marching towards the climax of this fourth turning. Federal Reserve that's completely had to write the playbook multiple times in the last 15 years. And by the way, export those strategies around the globe. Everyone copies us. And there is no plan B. That's what's scary. So here's what this means for your investments. Traditional diversification strategies are being challenged. The old 60-40 stock bond portfolio that worked for decades, it's not going to work anymore. We saw that in 2022. Both stocks and bonds fell significantly at the same time. Something that was not supposed to happen, according to modern portfolio theory, yet it happened. And by the way, the bond portfolio, part of that portfolio, is still way down. A lot of people aren't feeling that because stocks are way up. But 60-40 is probably not going to work. So we're also seeing massive sector rotations right now. Think about how quickly investor sentiment can shift from growth to value, technology to energy, to crypto, to AI, from risk on to risk off assets in just a blink of an eye. This isn't just about normal market volatility, it's the kind of structural uncertainty that defines crisis periods. Monetary policy has become unpredictable as well. The Fed kept interest rates near zero for over a decade, then they had to raise them aggressively, more aggressively than any time since the 1980s. A huge, quick interest rate increase campaign. Surprisingly, home prices stayed high and stock prices stayed high so far. That probably will not be the same as we progress through this fourth turning, and certainly as we progress through the crisis and climax periods of these fourth turning that we're in. And we really haven't even gone through those periods yet, the crisis and the climax. And meanwhile, the Fed is holding trillions of dollars in assets on their balance sheet from quantitative easing programs. Don't remember the last figure, but I still think it's 8 point something trillion. And at current interest rates, the Fed has massive losses, mark-to-market losses. Some estimate $1 to $1.5 trillion in losses on those bonds because rates are higher. They don't have to report that, but still, it steals from our future production. It's value that's destroyed because of these policies. And we're seeing renewed interest in traditional safe haven assets as well. Gold hit all-time highs in 2024. Bitcoin, despite its volatility, has gained acceptance as digital gold. Even real estate, despite affordability challenges, continue to attract investors looking for tangible assets. Here is gold on a monthly chart. This is a chart that goes back 20 years. This goes back to 2005. If I brought it back to 2000, you'd see that the trend has extended even further. In fact, gold has outperformed the stock market since the year 2000. It might have been tempted to put all your money in gold and forget about it. As of right now, that seems like it might have been a good idea in hindsight. We don't recommend that, particularly at these levels, but we do recommend you think about putting maybe 10% of your investable assets in gold and or silver, real assets like that. Of course, everyone's situation is different, and we're happy to talk to you about your situation. This is a weekly chart. Gold has now broken out this range. We've tested back the last couple of weeks. We're presently at around $3,300 or $3,400 an ounce on gold. We think it's going to go up to $3,800 an ounce in the coming months. That's what the charts say. And by the way, if we look at silver, it too has taken out what I would call a triple top at the 35 level, and we're up at around 36 or 37. This is an ETF that shows silver, so it's not exactly the same. But still, the chart pattern is the same. A big breakout higher in gold and silver. We're big believers there. And you might even think that central banks are influencing this. Central banks have been buying gold for many years. And we could prove that if you look at the data. And so what do they know that we don't know? Here's the crucial point of all this. And this is why understanding the fourth turning becomes your advantage. Crisis periods don't just destroy wealth, they redistribute it. Every fourth turning has created enormous opportunities for those that understand what's happening and position themselves accordingly. The families that built generational wealth during the Great Depression weren't the ones who panicked and sold everything. They were the ones who understood that crisis creates opportunity. You might also add that they had assets to take advantage of that opportunity, but still, they understood what was going on. They understood that this was only a season that would pass. However, and this is critical, the strategies that worked during the third turning, the unraveling period from 1980 to 2008, may not work during the fourth turning we're in now. That third turning terminated in 2008. Everything changed. We almost went on to a completely different paradigm. Some of the charts I showed you earlier about the shifting and valuations towards a more permanent level. We heard arguments for years about why that was, because interest rates were zero. Well, interest rates are not zero. They're 4 to 5%, 6%, depending upon which one you look at. And yet assets are still up here. Why? We were told before it's because of interest rates. Why hasn't interest rates mattered? Well, I can only think it's because we're all marching towards a climax here. And this is the way it has to be. Maybe we have to have an absolute blow off top where just it's an eye-watering move higher that everyone has to be in, and it's like a great grand finale fireworks show. I'm starting to think that that's the way that it's going to be. Different strategies are going to be needed here. Buy and hold is probably not going to be enough for what we're dealing with. Structural changes to the global economy. Traditional asset allocation models may not account for the kind of monetary policy experience we're seeing. Probably almost certainly won't. Even retirement planning assumptions about withdrawal rates and portfolio growth might need to be reconsidered. If we indeed have a 12-year period in the S&P that returns minus 6%, I think that most Monte Carlo scenarios, which are basically statistical financial planning models that try to predict future income and returns, they'll probably fail. So we have to realize that this point in time, this pinnacle that we're at, is as different as it gets when you look at over the last 80 to 90 years. So let me bring this home for you personally, because this isn't just about academic theory. This is about your financial future. We're living through the most significant economic transformation since World War II, and it's coming to a head very soon, if not now. If you're in your 50s or 60s right now, the retirement you're planning for might look very different than the retirement that you thought you have or the retirement that your parents have. The economy your children will inherit might operate under completely different rules than the one you built your career in. Your savings are under attack from inflation. We all know that in ways that we haven't seen in 40 years. That cash sitting in your savings account, you'll be lucky if you're even earning anything on it in terms of interest. But it's also losing purchasing power every month. The fixed income investments that were supposed to provide stability, they've been devastated by rising interest rates. Your portfolio might be a heck of a lot more vulnerable than you think. If you're following conventional wisdom about asset allocation based on your age, you might not be prepared for the kind of volatility and structural changes that we're experiencing now and that we're going to see in the very short years ahead. But, and this is critical here and crucial, there's also unprecedented opportunities. You have to be able to see them. You have to be mentally prepared for them. Every major crisis period has created new industries, new wealth building strategies, and new ways to preserve and grow capital. The question is, are you positioned to take advantage of them, both financially and mentally? Maybe you're worried about whether your retirement savings will last. Maybe you're concerned about leaving something meaningful to your children or grandchildren. Maybe you're just trying to figure out how to maintain your purchasing power in this environment that we're in, where everything seems to be getting crazier and more expensive. These are exactly the things you should be feeling and thinking about and experiencing during a fourth turning. And they're exactly why understanding these patterns are so valuable. The good news is once you understand what's happening, you can prepare for it. And that's exactly what we're going to cover in part 2 of this series. So please be on the lookout for it. Here's what I want you to do right now. Take a moment to honestly assess your current financial position through the lens of what we discussed today. Ask yourself, are your investments positioned for the kind of structural changes we're experiencing? What do you think is going to happen to the stock market as the crisis phase hits in full force, and then certainly the climax? The climax of all of this is probably the time that you want to go all in. But I can tell you this, the climax, that we are not going to be trading at these levels in the stock market when we see the climax. We're not going to see the most overvalued market in the last 100 years when we see the climax. When we're at the climax, probably no one's going to even want to talk about it. But that's exactly what you should be thinking about doing, taking advantage of it. So are your investments today positioned for what we're likely to see? If you're too passively exposed to risk, then I would say no. Get yourself down. If you're a passive investor, get yourself down to 30% equities or less. Consider adding gold to your portfolio if you don't have it, 10% or so. And again, these are all not specific to you, the viewer, in terms of investment advice. We can't do that unless we have a face-to-face conversation. But these are generalities. And please talk to your advisor or us if you'd like specific advice. Secondly, do you have exposure to assets that have historically performed well during crisis periods? Things like gold and silver, safe haven assets. Think about that. Is your retirement plan flexible? Is it flexible enough to adapt to changing economic conditions? Are you taking advantage of the opportunities that the fourth turning is creating? We probably haven't seen the opportunities that we're going to see until we get it deep into the crisis and climax, but keep your eyes open now that you understand this paradigm, this construct that we've been talking about. So next week in part 2, I'm going to show you some specific strategies that can help you not just survive, but thrive during this fourth turning, again, which is going to almost certainly climax in the next 5 years or so. How to build a crisis-resistant portfolio that can handle both inflation and deflation. Which asset classes have historically outperformed during fourth turnings. Specific steps that you can take to protect your wealth from currency debasement. And how to identify and capitalize on the generational opportunities that this crisis will create. If you're ready to have a deeper conversation about this and how these concepts apply to you specifically, I'm also offering a 30-minute complimentary consultation to anybody that wants to reach out to us. No sales pitch, no pressure. You don't have to become a client. It doesn't cost anything. Just an honest discussion with us about your financial future and how to navigate these challenging times. So please click the link below and reach out to us. Remember, the fourth turning isn't something that's going to happen. It's something that's happening right now, and it's going to climax over the next 5 years. The question isn't whether we're going to experience significant economic and social changes over the next several years. The question is whether you're going to be prepared for them. We're here to help. And I have to give a shout out to Strauss and Howe. All of the credit for this theory goes to them. We're only here to help you understand it, to create a bunch of bullet points, a cheat sheet, so to speak, and help you implement those ideas into your own personal financial life. And we're here to do so one-on-one, if you'd like, if and when you reach out to us. Please make sure to subscribe to this channel. Hit the notification bell so you do not miss part 2 next week. I don't think you're going to want to miss that. And if you found this valuable, please share it with somebody that might benefit from understanding these concepts. I'm Mike Preston from New Harbor Financial. I really appreciate you watching today, and I can't wait to see you next week.